Us to talk about this is Larry Cantor. He's operating partner at Atlas Merchant Capital. Also our guest host today, Jason Trennert. He's chairman at Strategas Research. And guys, honestly, that was my question this morning. Jason, why are we looking at the futures up by 116 points this morning?
Well, I think a couple things. One, I think people are starting to discount the idea that there will be a trade deal with China. That's partly, in my opinion, a political phenomenon, which is to say you're getting close to 2020, and the president, I think, wants to let the economy run hot going into next year. The other part, I think, which is interesting, is that money growth has picked up pretty meaningfully in the last 3 or 4 months. It's running at about a 9% growth rate. So you have a situation where the economy isn't growing particularly quickly, but liquidity is growing very quickly.
Because of central banks?
Yes, and it's because of Fed's easing. Yeah. And so, in my opinion, stocks generally are pretty counter-cyclical. They tend to, are driven by liquidity, and it's a very hard thing to stand in front of.
Larry, having said that, we're looking at a Fed meeting next week.
Right.
And if the Fed says anything that disappoints the markets or doesn't even give them the forward guidance they may be anticipating, we could be looking at a quick drawback.
Well, I think it's a done deal. They're going to do 25 basis points.
Right, that's what I mean. That's already baked in.
There's no mystery before
Fed. What else does the Fed have to say to...
You know, I think he's going to keep the door open and more easing and go on that train. I'm with Jason on this, not with the Fed. I mean, I think Fed easing's priced in for a while ago. But I think this idea of an interim trade deal is what's driving things. I mean, think about, we talk about stocks close to record highs, but as Andrew said, we're about where we were a year ago. And when you look at the corporate tax cut, the good performance of corporate profits, you'd expect the stock market and Fed going from tightening to easing.
Unless you could just argue all that got pulled forward a year ago, and now we're...
Yeah, we're just back. And so I think what happens is we are going to get a deal with China. I don't think there's going to be much substance to it. I think it's going to be just like NAFTA was. Maybe they'll rename it. And I think the market will do a lot better when that.
That's when you get what's a lot better.
10%.
10%.
Okay, so why do I pick that kind of number? Because I would expect, based on everything else besides trade, that you would be up at least 10% over a year ago.
Okay,
we're up a few percent.
So play this out then.
Yeah.
If the upside is 10%,
right,
based in large part on a China deal,
right,
what's the downside?
Right. Well, I think what's happening now is you're getting an explosion in credit. So corporate debt is going crazy. So at some point, we're going to have a downturn.
Right.
And so when that happens, it's hard to predict when. The fact that we're going into a presidential election year, and we have an incumbent running, tells me we're going to get a deal, and we'll get a better economy for a while and a better stock market. I mean, I don't think people realize how important trade is. I know we're talking about it a lot. 30 years ago, before all the free trade, it was about 10% of the global economy. It's now about 30%. Supply chains, for multinational firms depend importantly. The U.S. auto sector wouldn't be alive if we didn't have low-cost producers that they're taking advantage of, places to assemble. Same with the tech sector. Where do they assemble things? So this is really causing problems. After the corporate tax cut, we thought we'd have a boom in investment spending. We've had no boom in investment. Who's going to invest in this environment when the president can announce we're going to close the border with Mexico next week? I mean, so I think once we get through that, and I'd be shocked if it doesn't happen, because the stock market and the economy are the big things he has going for him. And so, it's to me, that's, and by the way, some of it's priced in. Some of it's priced in. Otherwise, the stock market would be even worse, I think. But I think people think it's going to happen. He just said yesterday he'd accept an interim trade deal. That's why the market's up today. We're not there yet. And, timing suggests maybe it's going to be later.
Sure. Jason, we had Richard Fisher here earlier this week, the former Dallas Federal Reserve president. And he said, look, you don't need to be easier as the Federal Reserve right now because banks already have plenty of money, nobody to lend it to. If they are getting easier and money supply is up, why do you think that's going to help?
So I would argue that the Fed has to ease largely for technical reasons. I would agree with them. Lower rates is not going to spur more capital investment. You have plenty of incentives for capital investment through the tax code now. The problem is that the rest of the world is obsessed with lower rates. ECB yesterday, in my opinion, what they did, negative rates. Yeah. And with $17 trillion in negative yielding rates, the Fed doesn't have as much flexibility as you would suspect. There's a problem, the dollar, and they found this out a couple of times in the last few years. If the dollar gets too strong, it tends to weaken a lot of risk assets.
So we're no longer looking at the same old agenda of why to cut rates and why to get easier.
Yeah, it's not to stimulate the economy. I would argue there are very real technical reasons why the Fed should ease. I also think it should take out, again, it doesn't make any sense. We have the highest policy rate in the world. We're flirting with a negative yield curve. I know that people say there's a difference between a flat curve and a negative yielding curve, but I wouldn't want to test the theory. And so I think the president, frankly, has been right on this. I'm not sure they should be zero. Rates should be zero, but they should be lower than where they are now.